Morning, everybody. We'll put Eastern Europe in context, a few facts and figures. We look at investment volumes, deal flow, finance pricing values, what's driving real estate investment, and also looking at just key trends in offices, retail, and logistics, industrial. So, in case you didn't know, that's Eastern Europe on the right, the pale blue. West Europe on the left. So if we look at some key facts, if you stick Eastern Europe and Turkey together, you get 50% of Europe's population, which is quite sizable. When you consider we've only got around about a third of office stock. It's grown proportionately post-crisis over the last few years, but only by a little. We contribute around 20% of GDP. Again, that has grown a few percent in the last 5-6 years. But investment volumes are around about just over 10%. Investment deals just slightly under 10%. So that, to me, that kind of a population, still a limited proportion, or not limited, but a lower amount of stock and certainly a low amount of investment volumes suggests strong long-term potential in the market. So if we look at what's happened to investment volumes over the last 15-16 years, obviously we've seen a pretty strong peak in 2007, very similar to the rest of Europe, if not globally. A dip significant to the trough of 2009, a bit of a bounce in 2011, back down in 2012. If the first half of this year is anything to go by, we think we'll do at least 10 billion in 2013. There's a little bit of a lack of clarity in terms of when deals are being announced relative to whether they're being closed, but deal volumes are certainly going up again this year. But the number of deals being closed is actually going down, which is quite interesting. There's a reason for that, and it's some pretty big transactions in the market, some of which I'm sure you've heard about. So Morgan Stanley has been pretty busy in Russia. This year they bought Metropolis Shopping Center, paying over $1 billion US for it. A couple of years ago, a year or so ago, they bought Galleria Shopping Center for over $1 billion. You know, there's 770 million for White Square, which is an office deal, Ritz-Carlton, and 288 million for Ducat Place. Some big deals in Poland too. Warsaw Financial Center was the largest office deal last year outside of Russia. Some pretty decent sized deals in the Czech Republic too. And these big deals themselves are actually contributing a lot to volume, but it means that the number of deals is actually dropping. But what it also means is, post-crisis, the distribution of deals is significantly changing to pre-crisis. So Russia's about 40% now. Poland, I think, is 29, it says. Czech Republic, about 15. Collectively, that's about 80% of the market. Then you got Hungary, then you got Romania, Bulgaria, the Balkans, and the Baltics. Pretty different to what it was like pre-crisis. So Poland is still, at the same level of market share. It's still doing strongly. It was the dominant leader. But then Czech Republic, Russia, and interestingly, Hungary had an equal split. So Hungary has fallen by the wayside, as it were. I think the question is, will Hungary come back? A lot of the other peripheral markets, I mean, they never really got going before the crisis hit. So at what point will they start to get going? One of the main drivers of real estate transactions is the availability of banking finance. It's changed quite a lot in the last few years. The markets in green have been relatively solvent. There's been reasonable availability of debt finance as a result of banking reform. All the other markets, it's been very challenging. You can refinance, but getting new debt has been difficult, and where you can get it, it's expensive. It's changed slightly, maybe a little bit in the Baltics since the end of last year. It's getting a little bit easier to get debt. And even in the last couple of months, according to my Hungarian colleagues, bank finance availability is actually becoming less costly and a little bit easier to find. The floodgates aren't opening yet, but it is a sign that it's getting a little bit easier. So maybe we'll start to see deals happening outside of the big three going forward. It could be 12 months, it could be 18 months. It may even happen at the end of this year. If we look at pricing, this may take a little bit of time to absorb. This is roughly the prime yield range for Germany's cities, and this is secondary office yield range. And these are the ranges for the different Eastern European cities. So if we say tier one, where debt is reasonably available, is Moscow, Warsaw, Prague, Bratislava. Obviously they're trading at a lower discount to Germany than the tier two markets. The question is, In Tier 2, is 300 basis points enough to get investors actively investing within those markets? I think that's maybe a question for the panel a bit later. If we look at values, so we look at Tier 1, Tier 2 index of capital values over the last 5-6 years, both are below peak, so there's still a bit of value or potential value growth within offices in both sets of cities. Tier 2 is below par. On retail, it's also just about below par and certainly below peak. Tier 1 is just about creeping above peak values, but that's been driven predominantly by Moscow. So there's still a strong capital growth story within these markets, short term as much as long term. So if we look at office in particular, we're seeing prime rents on average, and this is just an average, creep up gradually, again driven predominantly by Moscow. We also saw a bit of a dip in the second quarter of this year. There's a fairly significant short-term supply spike came onto the market, but that seems to have created quite an interesting short-term buy-side opportunity, getting in while rents are low because that space will be absorbed. Secondary rents have been bouncing along the bottom, and vacancy has pretty much been bouncing along the bottom. There was a sign that it may be creeping up, but I think it will actually start creeping back down next year. You do get pretty significant differences in markets, though, in terms of where they are positioned and what the actual vacancy position is. So we've got what we term the established markets, which have got the greatest amount of office space per capita. Once you get to this right side, 4 and above, you're getting into kind of Western European standards. You've got what are still relatively evolving markets, and then those that are emerging in terms of the volume of space per capita. Then you've got the vacancy rate. So if we talk about this natural vacancy rate band, if it's anywhere between 8 and 12%, above that suggests that rents are still going to be a little bit weak. Below that, rents may be growing. It differs per market, but that's roughly what the band is. But this, if you look at these markets, they're still either evolving or emerging. So once growth comes back in terms of demand, because the amount of supply that is vacant is actually relatively small, once demand starts growing again, it should be fairly quickly absorbed. So I don't think these markets are as bad as headline numbers suggest. And this vacancy rate is also what we're terming the operational vacancy rate. So it's stripping out all the let's say obsolete or practically obsolete buildings within the market that aren't really a feature of the market anymore. And I think markets are healthier than headline numbers of 20-odd% vacancy in Sofia might initially suggest. Particularly when you look at the strong GDP growth forecasts for the Eastern European markets. So if this is the forecast range for the EU in general, around about 1 to 2.2%. The only markets that is below par is Croatia. Everywhere is at least within the range, if not above. So that GDP growth next year should start to drive greater absorption and will start to support rents maybe 18 months down the line, 12, 18 months down the line. Okay, retail. I think retail is slightly different. These are approximate averages in terms of stock per capita. We've got what we think is the European average, and this is just for traditional shopping centres. It's not for all retail stock. Most markets are just about on the European average. I think Belgrade is probably the only market that's got significant development capacity in that regard. There's a few markets that are slightly above the Nordic average. I put the Nordic average in there because a lot of markets get quite cold in the winter, just like they do in the Nordics. Now that I live in Helsinki, I know all about it. So these markets look a little bit more saturated. And if you actually look at a couple of those markets in detail, there's very strong dominant centres, but then anything that is slightly secondary is struggling a little bit to get retailers in. Now the other thing that is yet to really kick in terms of having an impact on Eastern European markets is online retailing. There's pretty significant levels of growth in online retailing, according to Eurostat. So at some point that's going to start cannibalizing more secondary retail centres. I think the dominant retail centres will be absolutely fine, as they're showing to be, but it's going to be interesting to see how this pans out. I don't think anybody fully understands how it will pan out. If you look at the UK market, I think it seems to be affecting the high street more than anywhere else, or secondary high streets. We don't really have that many retail high streets in Eastern Europe, apart from the main tourism centres. So maybe the impact is not going to be significant, but there's bound to be an impact. And I think the most positive impact is going to be in terms of growth in demand for warehousing and logistics. If you look at Amazon's growing footprint, I think last year they set up another 250,000 square meters. Similar again for 2013. There are rumors that they're now looking at the Czech Republic quite genuinely to put something there. So that will be their first foray into the Eastern European markets. And it is going to be a source of growth in due course. There's a company called Ozon, which is growing quite significantly, just focused on the Russian market. The other thing that will drive demand for logistics and manufacturing in particular, we've recently done a study with Cornet looking at repatriation of manufacturing globally and in Europe to try to understand to what extent are manufacturers likely to pull production from Southeast Asia or Eastern Europe or more sort of non-core countries back into home markets. I think the interesting thing here is if they don't see things changing too much in Western Europe in terms of increasing their production lines, but the biggest growth market globally compared to Southeast Asia is Eastern Europe, Russia and Turkey. So that in itself is also going to increase the demand for logistics and warehousing space. Okay, so pros and cons to summarize. There's a very strong long-term investment story for Eastern Europe. Property values are typically below peak or par, so there's strong capital growth there. Bank financing conditions are improving. It certainly appears to be. Whether that's a short-term thing or a longer-term pattern, I'm not sure. Martin will probably tell us all about it. Office market trends, I think, are better than headlines suggest. There are some pockets of retail yet to be tapped into. I think industrial logistics has got the strongest growth potential. Cons, perception of some markets remains a barrier to entry for certain investors. Maybe a lack of depth in terms of local capital markets is also a bit of a concern for some. Yields may need to soften in some of these tier 2 cities to really bring buyers in and get them sort of actively interested. Is there enough product? That's also a question. How much product is there going to be sort of rotating around the markets year on year? Retail looks to be becoming saturated and challenging in a few specific markets as well. So that's it from me.
Great. Thank you very much, Damian.